Barron's recently put out an article saying that although Tesla stock has issues, or the company in general has issues, you should be considering buying the stock anyways. And I want to know what kind of craziness this article has entailed. So that's what we're going to cover in this video. So guys, as you smash that like button, let me run that intro. What's up, guys, and welcome back to the channel. Now, Barron's, it's pretty hit or miss, but, I find that I cover Barron's articles on this channel a lot more often than I do Wall Street Journal ones, because Wall Street Journal is just straight up news, where Barron's people take opinions, and so, I can opine on the opinions much better, and a lot of the times I generally don't agree, but Barron's has also helped me find some good stock picks to include in my portfolio in the past as well. And so let's dive right into this article. So this came out about a week ago, and they said that Tesla has issues, but you should be buying the stock anyways. And so let's dive into this. And I don't think they made a good argument as they started this whole thing in the first place. They're saying demand is slowing, costs are rising, and yes, Tesla is a mess right now, and signs point to difficult times ahead. So once again, not a good start, guys. You're not convincing me to buy the stock of Tesla. I actually, I came with a somewhat open mind, although I am biased because I've already modeled out the company and I have an opinion. However, I wouldn't mind if someone, changed my mind. I do really like, a CEO type like Elon Musk. And so they're saying delivery growth has slowed below the company's own goal. Now, fairness, we got to be fair where we got to be fair. And here it's like their delivery goal is 50%. Even if they grow at 30%, it's still exceptional, guys. And like last year, or for 2022, they grew at 40%. So in other words, what I'm trying to say is that it's not unremarkable. It is absolutely fantastic that they managed to grow so fast. They just set even higher goals for themselves. And so, if you're going to say delivery growth has slowed below the company's own goal, say what the goal is and state what delivery growth actually was, because it'll allow the readers to really see that the slowdown in delivery growth is still pretty damn good. But they go on to say, ignore all of that. Instead, focus on what Tesla is, a leading EV manufacturer in the world, and one that has a decade plus head start on other automakers. Now, you give a guy like Elon Musk a decade head start and you'll never catch him. I do agree with that. However, auto business is the auto business, and nobody maintains a sustainable competitive advantage for long, not even Tesla, at least in my opinion, and I could be wrong. Tesla is able to produce cars at much lower costs than its competitors, giving it room to cut prices to stoke demand in ways other can't. And the other thing that I'd add to that is Tesla's probably able to sell cars cheaper than other auto manufacturers are able to sell cars as well, because they don't have to deal with that dealer network as well. And so Tesla does have cost advantages, in addition to the fact that, can we just call a spade a spade? They also have a technology advantage as it stands right now. And so Friday's news that Tesla would be cutting price in China underscores the current dilemma. Tesla has been focused on growing production. And, because this article came out over a week ago, they're saying that the price cuts which may be coming to the U.S. in the future will hurt its profit margins. Well, price cuts have been announced in the U.S. this past week. So those price cuts are here. Now, what do they really do? I think, in an environment where you have more competition, if the two companies are priced approximately on parity, I would take the Tesla over, a BMW or anything else. The reason for which is because, I expect Tesla to get to that full autonomous driving status a lot sooner than any other manufacturer. That being said, I'm not an EV purchaser right now. I live in a very cold climate, and so it doesn't make a lot of sense for me anyways. But, the point that I'm making is that if you are a purchaser of EVs and these things are priced at the same price point, probably makes a lot of sense to purchase a Tesla right now. However, that being said, if you start seeing some of these new luxury models come out, the Porsche, I do think, there's the Polestar as well. I do think that these companies are catching up to the level of luxury. However, are they catching up to the level of technology? I think Tesla maintains sort of like a lead in that area for at least, the next 5-6 years, at least in my opinion. Who knows? People could probably catch up a little bit faster. But with that said, the analyst goes on to say, that's Tony Scannocci, I guess, from Bernstein. He goes on to say that Tesla will need to either reduce its growth targets and run its factories below capacity, or sustain and potentially increase recent price cuts globally, pressuring margins. Now, we kind of already know what they're going to do because, we're in the future now. They are focusing on top line revenue growth. And I think that's what you really need to do, because you want to kind of be like the iPhone, where people just get used to using that car and then they just continue to buy that car. Hopefully that works. It really doesn't transcend into auto the way it does with handheld phone devices. However, you could, make a solid try at that. And so I think Tesla is going to substantially sacrifice margin in order to continue to grow out that top line of revenue growth. And that's exactly what this article is saying. They're saying for Tesla, the choice is obvious. It will cut prices to juice sales, so continue overall revenue growth. So the idea here is that they are making less revenue per vehicle, but they're just selling more vehicles, especially once they get the vehicles under that EV credit limit. This will, of course, hit its margins, but Tesla has margin to spare, at least according to this article. But, I say, does the valuation have margin to spare? Look, the company will be just fine. The company will do fantastic. However, the investor may not necessarily do that well. And so if the company's cutting margins and or they're cutting prices, and so thus they're reducing margins, we have to value that in. And that's something that I have valued in and showed you guys. Some people who are Tesla bulls actually got mad at that, but it is what it is. Men lie, women lie, but the numbers don't lie. Now, Tesla could sacrifice some 10 percentage points of margin and still be profitable as, say, the BMW Germany, but what it really means is that they're ultimately going to hurt the investor. And they're not saying that here, but that's what's happening. And so they go on to say that Tesla is expected to generate the most free cash flow amongst automakers in 2023, some $12.2 billion, up from $9 billion. But who knows if they're going to generate that much free cash flow, because if they continue to cut prices, they continue to get aggressive, and we have a bit of a consumer slowdown, who knows? You might just be chasing the same amount of revenue that you got last year and a lower margin on top of that. And so they plan to launch their Cybertruck in 2023, and they could also announce a badly needed lower cost car as its investor day is scheduled for March 1st. So all eyes will be on the investor day, so we'll see how this plays out. And drivers have shown, and this is pretty cool, drivers have shown a willingness to pay $15,000 for his top driver assisted software. That's a product and revenue line no other automaker has. But what that really underscores is that this is a luxury vehicle. If you're going to pay $15,000 for a piece of software, and that's the consumer you're going after, this is a luxury vehicle. If you want Tesla to start selling cars to the masses, you're going to have to appeal to the masses, and a $15,000 software upgrade won't necessarily be that. Now, I'm not saying that they have to sell that to the masses. That's not what I'm saying. The point that I'm making is right now, Tesla is very much seen as a premium vehicle at the luxury level for people who want the top level of technology. The average buyer who's buying an EV just wants something that's somewhat comfortable, looks okay, and runs, 3 to 500 kilometers. I don't know what that is in miles. You Americans can look it up. But essentially, they're not looking for top of the line anything. And so, Tesla really has to sort of try and capture this market. And I just don't think that they're going to be competitive in that space in the future as more and more competition rolls out. Now, when it comes to these types of newspapers, I always love to read the comments, because sometimes the people who are making the comments provide something that's very interesting. And so I actually found the first comment of this article that was really interesting, and I want to read it for you guys. So HC says, I recently did buy Tesla at $110 per share. So this is a Tesla bull, but I would not agree with the logic that Tesla has a 10% margin to cut and still enjoy the same margin as other automakers. If Tesla has the same margin as other automakers, it would likely also have the other automakers' PE multiples, which is about a third of what Tesla enjoys now. Tesla is valued as a tech company. You don't want to see it valued as an auto company. And so, I said it from sort of like the mathematical perspective of like walking you through the valuation model and showing you how the margin compression creates a lower valuation. This guy said it in a much simpler way. The company's valued higher because it's a technology company, or seen as a technology company right now. You bring those margins down, it's going to be looked at as an auto company. I look at it as an auto company, and with margins coming down, but not a lot of Tesla bulls do look at it like that. However, the point that I want to make is that when it comes to inevitability, this isn't one of those stories where the future for Tesla is inevitable. You're inevitably going to be making money on that. And so from my perspective, I still remain someone who's not going to buy Tesla at any price. Now, you guys let me know what you think. Let me know in the comments below. Now, the other thing is the Chinese government, the CCP, recently took out golden shares on Alibaba and Tencent. And so what does that mean for investments in China? And I actually covered that in this video right here.